Well, I think the most important thing with investing is you're making sure your money is working for you and you're not working for your money.
Welcome to the Immigrant Doctor Podcast, a podcast for financially focused immigrant physicians and other medical professionals looking to learn investing in the U.S. market and achieving financial freedom. Join Avishkar, the Immigrant Doctor, as he talks to high achievers and go-getters who unravel their journeys, hardships, and successes, helping you to get your financial freedom. To learn more, go to theimmigrantdoctor.com.
Hi folks, so I just wanted to give you a heads up that this episode has been divided into two parts just because this was a very long conversation that I had with Shamaz, and it was a very, very interesting, very fun conversation. But just because the sheer amount of information that was shared, I felt that it would be probably better that we divide it into two parts so that I can make bite-sized, chunks of information that you can understand better and grasp these concepts much better. I hope you enjoy this podcast, and I look forward to hearing this and then the subsequent episode next week. Hi, everyone. Welcome to another episode of the Immigrant Doctor Podcast. I have with me an amazing guest today. His name is Shamaz Mayginnes. Did I pronounce your last name right, Shamaz?
Yes, you did. Mayginnes.
All
right. It's a hard one.
So, it's an interesting story, folks. I met Shamaz at a conference that we both were at, and we were having lunch together. We just happened to be on the same table. I didn't know who this guy was, but something about the way he was, he looked pretty laid back, pretty chill. I was like, let me talk to this guy. And we started discussing, and he told me that how he's been in the stock market industry for a while. And that was something very interesting to me because I know about real estate, but I don't know anything about stocks. And I figured I need to have this guy on my show. So I'll give you a brief introduction about Shamaz. So he's the Chief Investment Officer at Clear Trust Advisors. He is an investment banker. He's well-versed in both civil and common law. And, he's held a bunch of licenses through a broker-dealer, which, some of you may know and some of you may not know, like a Series 3 license, Series 7 license, Series 24, Series 34, Series 63, and Series 65. He used to work with Bear Stearns at Lloyd's of London, and now, like I mentioned, he is the Chief Investment Officer at Clear Trust Advisors. So, Shamaz, welcome to the show.
Thank you. It's a pleasure.
Yeah, it's interesting how you meet different people who are a wealth of knowledge in different aspects and how they can help you gain knowledge about what you want to know. And I think the reason why I wanted to get you on was pretty much because it was a selfish reason. I don't know a whole lot about stocks. I think what we can do is we can start with talking about something about, a broader concept of how money works. And I think we can probably go into doing some sessions in the future where we talk more about how the stock market works. What do you think?
Sounds great to me. Yeah.
All right, so let's talk about money. This was something that was very hard for me to grasp because a lot of times what we think of money is that you earn it and you store it away and you keep some money for a rainy day, right? So I want to ask you, what's the difference between really investing the money and storing it in the bank?
Well, I think the most important thing with investing is you're making sure your money is working for you and you're not working for your money. And I think that's a cornerstone of building wealth. Making sure your money works for you.
But it comes with this mindset of, you're investing your money, but it's at risk, right? Even though theoretically, it sounds like you're investing your money and you're making it work for you. But at the same time, that money is not sitting in your bank. And I think it requires a little bit of a shift of mindset. And do you experience that with your clients when they come and talk to you?
All the time. This concept of risk is so difficult to manage, and I think every day it becomes more difficult to manage because what's happening today with the Chinese yuan, or however you pronounce it, and oil, you never know what you're standing on. And then we're taught to think that certain things are risky just because, but we're not giving a solid reason why it's risky. So we'll deposit our money in a bank, and then that bank will go do exactly what we're told not to do.
Right. They invest their money. So let's talk about how the money works. How does this work? And I think that's going to be an eye opener for all of us. Is how does the bank use our money? Where does the money go in the bank?
Well, I mean, most banks today are investing in mortgage-backed securities. So they're trading it in derivatives. What happened with SBB and different banks. All the banks are trading and playing with money. And how they work it is usually they wrap mortgages, and then they sell those mortgages, and then they wrap it again, and it's called a synthetic, right? So they wrap one mortgage 20, 30 times to create liquidity.
Oh, wow.
And that's where they get their massive leverage.
So it's like they gift wrap a mortgage and they give it to another bank, and then they gift wrap it again, and then they give it to another bank. Is that how it goes?
Yeah, it's called a referenced portfolio. Yeah.
Interesting.
It's
so
kind
who's
of
finally
scary.
paying for this? Who's finally paying? I mean, that money's got to go somewhere. Who's finally paying? This is so interesting. What's going on here?
Yeah, I don't know what's going on. I mean, every day it's more insane, because on top of that, what they're doing today, which is new since 2008, is they do that and then they sell that note to the U.S. government, right?
I see.
And they called it
so finally the U.S. government is paying for it?
Yeah, they called it quantitative easing.
Interesting. Can you explain a little more about how this goes, and just so that all of us can understand? I know that you have this background in finance, but for somebody like me, I don't understand all of this, whatever the terms that you're using. Can you just explain it, simplify it a little bit for us?
Okay, so and coach me if I miss something, but a normal bank goes and they lend to someone to buy a house, right? And that's their core business. Previously to 2008, that's when the U.S. government would print new money. So they would print money, and that's how the increase in money supply would happen as the bank would lend to someone to buy a house. So since 2008, what they started doing was printing those things and then wrapping them and then selling them to the Federal Reserve, which never happened before. And so they would and they call that a note, or a derivative, right? They would get $1 billion worth of notes or mortgages, wrap a contract around it. Does wrapping make sense? Like they would say, this portfolio of 1,000 mortgages is referenced on this note, and then they would sell that note to the U.S. government, or the Federal Reserve, more appropriately.
So why was the Federal Reserve buying it then?
Well, yeah, that's where it gets really juicy. Before that, it was sold to regular investors like you and me, and it was sold to pension funds, and even retail investors would go and buy notes, and it was great. Oh, you're investing in a AAA backed note from Goldman Sachs or Bear Stearns or JP Morgan. And they kept doing this, and this is how the banks started getting massive amounts of liquidity.
Got it.
And they got a lot of people talk in the subprime debacle that, it was the pole dancers and the waiters. And it's interesting to me because the subprime mortgages, even to this day, even when they started defaulting, is the best paying segment of the U.S. economy, global economy, really. For some reason, poor people pay their debts better than... And so my question was always, well, how can you explain to me that the poorest people in the U.S. bankrupted the whole world?
Right.
So what happened was they created synthetics. And a synthetic is they have a reference portfolio of mortgages and they sell it more than once. And they were selling like 50 times. I guess there's even rumors of 70 times over.
Interesting.
So the default rate in pre-2008 was less than 1%. That's why it was qualified as AAA security.
Got it.
And so they referenced that portfolio 25, 30 times over on all these notes where they were raising massive amounts of capital and then doing what with it? I don't know. They weren't investing in more mortgages. There's not enough mortgages to invest like that. And
I see.
When something went wrong, and even the default, say it went up 300%, then you're talking 3% default rate on the mortgages. That's nothing. It's a really good rate.
Right.
But wherever they put that money or wherever that money was taken, then it was lost or stolen. I don't know what happened. And then
somebody did something wrong.
Then there was a big, huge trouble, and the U.S. government had to step in. I think it relates back to the, Equal Housing Act. It created this, moral hazard, where the bank said, "Oh, we can lend anywhere, we can do anything," and since the government told us we had to do it, well, now they have to bail us out. Now it gets kind of weird, so I let people think what they want to think.
So in a nutshell, basically, the way the banks work is you say take a loan from the bank for whatever reason. Say I go and take a loan. They arbitrage because they're asking me for an interest rate on it. So it's like they give me the money now, they lend me the money now with a promise to pay in the future. And they're arbitraging that with an interest rate. So that's where they make their money, right?
Yeah.
And so obviously the money is not just sitting in the bank. The moment it hits our account, it reflects as a number on when I'm looking at my account, but it doesn't necessarily mean that it's sitting there. They've already invested my money somewhere else.
Yeah.
And so what they're doing is, even if they say that they're going to give me an XYZ% interest annually on the amount that I put in the bank, it's basically a very puny amount compared to what they're making as an interest on the investments that they have made from my money that's sitting in the bank.
Exactly.
And from what I'm understanding is that basically they say, for example, somebody takes a mortgage, they would put a nice wrap around it, and then they would sell it to somebody else who would be willing to pay a higher premium because it was a better, because their investment ideology was different, and they were looking at it from a different perspective than what the bank would be looking at it like.
Exactly.
And so they would make their money there because it's not just about the returns, it's also about the investment philosophy of whether you're looking for a low return, more safe investment versus a higher return, a slightly riskier investment. And I think that's my understanding is what wrapping would be. Am I correct in understanding that?
That's 100% right. And I'm sure you're more articulate than I am, so.
Folks, I just wanted to remind you, if you haven't done that already, head on over to www.theimmigrantdoctor.com. I have created a free video resource for you guys. It's a small course that I've created on investing in real estate. It's not very extensive, but it just gives you a flavor of what investing in real estate looks like, so that you can get started, get more comfortable with the terms around real estate, and get more comfortable with some of the facets of real estate. So go to www.theimmigrantdoctor.com to download this free resource. So in essence, what I'm understanding is the money keeps moving, right? So money doesn't stay. And so why is this movement of money important? I mean, we can just put our money into the bank account and then the bank can just store it. Like, I thought that was the whole purpose of how this banking system came about. So why do we need to keep moving this money around in the financial market?
Well, liquidity is what enables us to realize our gains. Like if you go to Europe, that
Right.
you have properties that have been passing down for 5, 10 generations, 500 years, 1,000 years, and it's worthless. The property is worthless. You can't sell it. You can't do anything with it. Some of these towns have just they don't even work anymore.
Interesting.
And so the government is sponsoring people to go live in these towns.
I know, yeah, because in Italy, I think they're giving you $1 to buy. You can buy a property for $1. That was just crazy when I saw that online.
Yeah. My wife is Spanish, and there's even offers to pay you $10,000 to go live in a town. It's
Oh wow, yeah. So it's in a sense it's important to understand that the movement of money is important, not just storing it somewhere. That's not doing anything for anybody. As long as the money keeps moving and keeps changing hands, that's how the economy works, and that's how we make our money and everybody else makes their money.
Yeah.
Right.
And that's the genius idea of the exchange, right? Where the exchange is where you have market makers and you have people interchanging value for stocks, and this creates a huge liquidity, and everything is in there, not just companies, but mortgages
Right.
Are in there. Everything you can think of, commodities, currencies, and as that moves, that gives us a great amount of liquidity to buy homes and sell homes, buy commercial property and sell commercial property. It's all because of that exchange of money.
Right. And I think it's also interesting to understand that that's where this whole concept of leverage comes in, because if you're storing money away to buy something later, versus if you're using leverage, say from a bank, for example, a mortgage to buy it, you're able to move a whole lot faster, reaching your goals. Now, whether you're using that loan to buy assets or liabilities is a completely different question.
Right.
But I think if you're using that to buy whatever you're buying, you're moving a whole lot faster in whatever direction you're moving in than, versus just storing the money and then using it at a later date.
Yeah, and that's what's beautiful about leverage. Leverage can be extremely dangerous, but it also can be a fail-safe. You can use leverage to protect yourself against risk.
Right.
Because you can,
Right.
In investing, you know about cost averaging, right?
Right.
So if you go into a position very conservatively and then it moves against you, you can cost average down, and you have plenty of liquidity not to worry about margin calls, not to worry about, I can't cost average. So leverage is an extremely powerful tool that can help you both conserve your wealth and position yourself, as well as if you're stupid and greedy, then you can blow up, and then you lose everything.
Well, the other thing is interesting concept about money is the way we talk about it getting devalued over time. I think it was this crazy thing that I read somewhere or somebody was talking about it, that the dollar has lost 90% of its value in the last 40 years?
Yeah, or 50
something like
years,
that?
something like that. It's something insane. Yeah.
Yeah, how's money getting devalued? What does that even mean?
Well, I think we're at an accelerated rate. It might be even worse than that over these last since 2008. But you print more of it, then it's worth less, right?
Right.
And the only way to really resolve that issue is, for me, I'm a money supply, or a supply side economist person.
Okay, what does that mean? I have no idea what that means. What is a supply side economist?
Yeah, I'm stumbling over my words. So, but there's Keynesian economics, where they think that the supply of money creates more commerce, and you just keep printing money, and that's every economy has been doing that since World War II.
Okay.
Now, the other concept, classical economics, is where if you build it people will need it. If you innovate and you make something more amazing, then people will want that. And so the more you build something and the more economical you can build it, the more people will buy it, and then you can create a deflationary environment. And deflation is a beautiful thing. Like, a lot of people are terrified of it. And I don't I think that's a government thing, not to be a conspiracy theorist. But the GDP, the government always wants the GDP to grow, and if you put some inflation in there, it's going to grow. Whereas if things devalue, they lose how much they cost to buy, deflationary, then more people have access to it.
That's true. And I think it always moves in cycles, right? The economy always moves into an inflation phase and then goes into a deflation phase. And I would just, I would be very curious to know what your thoughts would be with respect to the Japanese market, because I read this also at some place that the Japanese market, the inflation rate is like very low and it stayed really low.
Yeah. Amazing.
So how does that contrast to the U.S. market, and what does that mean to us as investors?
Yeah, that's a head scratcher there. They're our largest investor, right? They own more treasury bonds, I think like 15% or something like that.
I did not know that.
Yeah, and then after them is China, which I believe Japan has 50% more treasuries than China does. Like,
interesting.
Yeah.
So even at that global level, the money is still moving. It's not like just restricted to the American economy and what people are doing only in the U.S., but it's like there's global investment that's occurring into the U.S. as well, and vice versa.
Yeah,
that's occurring.
Yeah, I mean, Japan is an extremely interesting market. I follow it. Because they were the first country really to do the quantitative easing, and they failed at it. It caused their huge slowdown, and they overprinted money, and they've been dealing with that for since the 60s.
Wow.
And now there's a lot of talk like, oh, they're printing money and they're doing this, and I can't follow it exactly because it doesn't track when you go and look at the actual statistics in the Bank of Japan. They don't track with the news that you hear and read. So I'm not sure how that whole thing works, but what I do believe is that since the interest rates are so cheap, all of the global investors are getting their loans via the Japanese yen.
Oh, interesting.
Yeah, and so there's tons of speculation happening on the Japanese yen on top of that. And these big defaults and losses that have happened over the last year, I think because the short sellers and the speculators on the yen are getting hammered.
I see. Okay.
Yeah.
So there is some amount of speculation, because as an investor, I don't invest in speculation. But I guess some people do invest in speculation.
Yeah. Well, speculation is an interesting term, right? If you look it up in the dictionary.
Yeah.
Right? Because commerce is considered speculation. But when we
that's interesting.
But when we go to the market, speculation is like gambling, right?
That's my worldview of speculation.
Yeah. So, yeah.
What about this, this debt that is ever increasing? You turn on the news channels and, there's always this something about, the national level debt has gone up to this many trillion and that many trillion. As it is, these trillions of dollars are hard to comprehend numbers. But what does this mean for people who are investing in the U.S.? And why is this important to us?
Well, for me, it's a huge problem because the fundamentals are super hard to follow with all of the printing of money. since we're printing money at a scale that we've never done before, right? I think in 2020 we printed, what was it, like 60% of the money supply in 1 year.
Oh wow.
And just blew up. And that statistic, it might be worse than that. I can't remember. It's been a few years. So you can research that. Everyone can. But it's an insane amount of money was printed. And they just keep printing it. Like we've raised the interest rates, and banks are failing because they bought long-term debt or long-term treasuries, and yet here we go printing money again to save the banks. What does that cause? You know, how can we gauge where we're at when we don't have failures, when we need failure? We need to see who. What did Warren Buffett say? When the water goes out, you see who's swimming naked.
I don't know that quote. This is the first I've heard of it. I've only heard when there's bloodshed on the streets.
Right.
That's when you go and buy.
Yeah. So, but yeah, we're not actually seeing the problems, which is a shame for me. You know, like the free marketplace, when everything blows up. I grew up, you know, without running water or light. So I came from when the whole world blows up and there's a huge economic meltdown, the poor people don't know. Nothing changes for them. It's like the same.
Right.
But when you have massive fallouts in property and you see the real devaluation or deflation that needs to happen in the market, that's when lower class people or people with less money have an opportunity. Because if you have a $500,000 house and then all of a sudden it's $100,000, people who could never buy that house are going to buy it. And we don't have that natural ebb and flow in the market where we just keep bailing out the big people, and the middle and lower class just become poorer and poorer.
Interesting.
Yeah.
But then, how do we as investors take advantage of these cycles that occur?
Well, like that saying you said, when there's blood in the streets, even when it's your own, make sure you buy. Yeah, I think right now we're in a huge, amazing time because I don't know how far the Federal Reserve can go this time to bail out the banks. Right now, they are bleeding out because all these commercial mortgages are coming due, or their ARM loans are going to start becoming variable, and they're not going to be able to afford. And this is fallout from 2008, where they got bailed out, they got quantitative easing, so they didn't have to auction off all their properties. They held them, they grew, and then they slowly sold them off through this big boom. Now they're not. I don't think the Reserve is going to be able to bail them out. And those interest rates.
Shamaz, just for our listeners, just so that they understand, can you just explain what it means for the ARM loan to become variable?
Yeah, everybody knows variable loans, right? With their ARM loans, the residential type ARM loan is 7 years. So commercial ARM loans are usually around 10 years, 7 to 10 years, but generally 10 years. And the first 3 years are fixed. Okay. And then on the third year, what happens is then they go with the going rates, plus whatever, I don't know, 2%, something like that, plus. Sure. And so they go up or down. So if you have,
depending on the market,
if you have these 2% commercial loans that were out there, all of a sudden they're going to be paying 7%, 6.5%. These properties, the commercial properties and multifamily units, are just going to get hammered for these big time banks and everyone, and I don't think there's anything that the Federal Reserve can do, and they'll have to start selling them.
Yeah, I think it was an interesting thing that I was reading somewhere yesterday. Somebody had actually posted a summary of an article they read somewhere about, I think, $20 trillion of debt is coming due in 2025.
Wow.
And it's going to default. Again, these are all such huge numbers. I cannot validate the source of this information, and I don't know if it's real or not. But I would imagine that this would be real just because of the way the economy works and the way the last few years everybody's been on a buying spree of all these properties. And when their loans come due, it's going to be a big mess and a big opportunity. And that's what everybody's been talking about as well right now, is that this is coming. Like, this is going to be when wealth is going to shift hands.
Yeah, how exciting. I hope that a lot of entrepreneurs and middle and lower class people who are hungry and want to move forward in their lives can take advantage of this time that's coming.
Folks, some of my guests may actually have, some mentorship programs. They may have some deals that they're working on, and you might get interested in working with them. But please bear in mind that I haven't done any due diligence on what they are offering, and you should do your own due diligence before you start working with them. Having said that, these are very high quality guests that I'm trying to bring on so that they can provide good value to you, and they're hardworking individuals and they have integrity when they work. But you should definitely do your own due diligence. I haven't done that due diligence on what their programs are, what their deals are. So please do your due diligence. I don't want to be held liable for anything that they are offering and you join that program or that deal with them because you heard it on my podcast.
Thank you for tuning in to this episode of the Immigrant Doctor Podcast. If you would like to learn more, head to www.theimmigrantdoctor.com. See you again soon on another episode and another amazing journey.